from a cash perspective, I've made profit of 10 grand. I actually have that cash in my pocket. From a tax perspective, I've made a 5 grand loss. Depreciation, I say this word quite a lot, is basically just writing off. When you buy an asset, it doesn't become an expense. It doesn't reduce the income in your name straight away. It always sits on your balance sheet as an asset. The only time you can claim some of those expenses if you depreciate that asset, i.e. the asset loses value and you can write it off. So depreciation is a great way to reduce your tax because it's not a cash expense. If you bought a car or you bought a house and there's capital improvements in there and you're writing off the value of the house for wear and tear, you're not spending money on it. So when you get a depreciation schedule done for your property, you might spend like $500 or $700 for a depreciation schedule. And what it does is a quantity surveyor or QS comes in, or actually, no, it might not even be a QS actually. It might be a tax depreciation accountant specifically for properties will come in and they look at all the house. They actually physically look at it and they go, okay, so that they have an aircon, they have curtains, they have carpets, they look at it and what they do is they assess the value of your fixtures and fittings. And what they do is they assess the life, so the useful life that's left in those assets. Once they assess that, they can assess what the value, depreciation of the value itself comes in. Now, I've seen depreciation schedules spitting out depreciation worth 15 grand, or 17 grand per year. How that helps you is obviously if you have a rental property and you charge rent, you pay all your expenses, and then you pay your interest on your loan as well, and you have a profit at the end of the year of, let's say, 10 grand. Usually without a depreciation schedule, you're going to get taxed on that 10 grand. Then your return on investment drops, let's say by 30%, to keep it simple, it drops to 7 grand. Now, if you have a depreciation schedule, you include that depreciation in it. And if it's a 15 grand write-off, like I said, it would drop the rental property from 10 grand profit to a 5 grand loss. Now, the benefit of the 5 grand loss as well, you can offset that against any other income that you earn in your name. So salary or trust distribution income. So you still use that deduction against other income. So what's happening here is you have, from a cash perspective, I've made profit of 10 grand. I actually have that cash in my pocket. That's actual cash. From a tax perspective, I've made a 5 grand loss because of depreciation. So i.e. my $10,000, I didn't pay any tax on it, but I didn't spend that $10,000 to get the 15 grand in deduction as well. I didn't spend that money. That was through the building being written off over time. So it's a great simple strategy